Good morning, I'm Kim Abril, the founder and portfolio manager of Global Quality Hedge Fund. And today I want to continue with the second part of our first video related to balance sheet liabilities in our topic of how to detect accounting red flags. In this case, I want to introduce the concept of factoring and reverse factoring. And to explain the concept, I want to use a practical case. In this case, ACS Group is a Spanish construction company. So let's start with this case. So here in the first slide, I want to show you the trend in working capital as percentage of sales for the last 30 years. As you can see, the trend is decreasing. So in 90s, the working capital as percentage to sales is across to 10%. Right now, today, it's across to 2%. The main reason for this decrease is related to the lower wage of the industrial sector in the total economy. So industrial sector is a heavy capital sector, so they invest too much capex in the business. So across the last years, technology sectors and sectors that they are light sector, they are increasing in the total of the economy. So this is the reason because working capital as percentage of sales goes down. And if working capital as percentage of sales goes down, operating cash flow goes up. So also R&P systems and other things can contribute to this decrease in working capital. But there are some parts of this fall or this decrease that is not consequence of the lower wage of the industrial sector. Is it consequence of financial engineering and a more aggressive accounting to increase operating cash flow? So most of the time, companies they have some pressure from Wall Street analysts, and when they report quarterly or annually numbers, they have to at least have the same consensus number or to try to beat the consensus number. So companies, they have some pressure to try to increase free cash flow numbers, right? So if you remember in 21, Enroll has some problems, some scandals related to practices associated to bad working capital issues. So many indebted companies try to securitize accounts receivable to avoid to increase debt levels, because sometimes these companies are really indebted. And if they securitize accounts receivable, they receive cash in advance, for example, from a bank, and that means to increase cash flow, operating cash flow, right? So also in 2001, the new law Sarbanes-Oxley was created in part to prevent future misuse of balance sheet financing methods. So there are more things or more ways to make of balance sheet financings, but this is one, right? So from now until the end of this video, I want to introduce two typical working capital bad tools or artificial bad tools to try to improve the working capital as percentage of revenue. One is factoring, and the second one is reverse factoring. So what is factoring? Factoring is when a company transfers part of all of its accounts receivable. So many companies with low credit profiles use factoring as a cheap way to finance, right? In Europe, they use Euribor plus spread, and in US or UK, they use LIBOR. So the reason to use factoring is to increase operating cash flow in the current period, but to decrease the operating cash flow in the future. So you can increase maybe the next 2, 3, or 4 quarters, or maybe you can increase the next 2 or 3 years, but sometime in the future you will start to decrease operating cash flow, right? Other way to look at the same point is to look at days sales outstanding, because sometimes that metric can give us an incorrect image or reality of the company. So there are two types to securitize account receivable. The first one is to account receivable remain in the balance sheet. You should to make, as an accounting way, you should to make a dual accounting entry. So you get up cash in the assets, get up debt in the liabilities. You have neutral effect in operating cash flow, but cash flow from financing is increasing. Second type is account receivable go out of the balance sheet, and this increase operating cash flow, right? So in our opinion, we think that securitize account receivable is a financing decision, right? So because this decision increase operating cash flow, but this increase does not exist within the normal operating cycle of the economy. So this is because we think this is a financial decision. So which is the accounting adjustment that we have to do? Because we should do the reduce operating cash flow and to increase financial cash flow. So reverse factoring is the opposite to factoring. Okay, and in other words, a company can transfer its payable account to a financial institution or an intermediary. Sorry. There are different reasons for this operation. The most typical is a company that wants to extend the payment term to suppliers, and also the provider wants to receive the cash in advance. Okay, there are a third reason that the bank gets a discount to pay the supplier, but in general, the first one, so to extend the payment term to suppliers and to increase operating cash flow, this is the most typical. It's important to remember here that there are some liquidity risks, and it exists when a company with a weak credit profile in an environment like today with credit restrictions or where financial markets have difficulties, these companies, if they are doing factoring, this is a risky company and you should to review this information in more detail. Here the adjustment is the same, reduce cash flow and increase financial cash flow. So let's start with our example. ACS is a construction Spanish company. Market cap for this company is 6,275. ACS has a net debt of 1,300 million euros. And while this company is a global company, it's present across all the world in construction business, services, and energy activities. In our opinion, ACS is not the typical company that we want to have in our portfolio because they don't have any competitive advantage. And there are two reasons because it's difficult in this sector to have competitive advantage. The first one is this, the construction business and energy business is a competitive one. So is it difficult to find mini monopolies or local monopolies or oligopolies? So this is a competitive sector. And most important, this is a cyclical sector. So the net income and the cash flow for this company fluctuates across the business cycle. So if you remember some other videos that we make about where we talk about the attributes of our portfolio of shares, we never invest in cyclical sectors. So we never invest in companies like ACS. Okay. Here below you have a chart. The idea to look here is to look the trend in working capital, not for the whole economy. If you remember the first slide in the presentation, when we talk about the average working capital as percentage of revenue for SPX companies, here we can see from 1990s, from today, at the end of 2019, the historical working capital trend for ACS. So here you can see that companies start to be worse from the financial crisis, okay? And at the end of 28, this company has a cash conversion cycle of close to 50 days, sorry. And then, is it true that the company reduced leverage and tried to improve working capitals? And at the end of 2012, 2013, the company decreased these 50 days and was in a zero cash conversion cycle. And at the end of 14, the company starts to improve again working capital. And this is, for me, suspicious because I want to know, and we can see in the next slides, if this improvement in working capital, is it related for a real improvement or is it related with tools like factoring and reverse factoring? So at the end of 19, the company reports a cash conversion cycle of 37 days. So let me explain you if this is true or not. So if we go to the annual report of 2019, we can see a table related to working capital. Okay, this table is in Spanish, but okay, I'll try to explain in English. Don't worry. So here we have a table from at the end of 18, at the end of 19, and 3 quarters in the middle, and these names is the business, the segments of this company. Most of the biggest segment here is infrastructures, okay? And then we can see the total working capital numbers for at the end of 18, okay, 5,800, and at the end of 19, 7,116, okay? But in the text, in the notes, company explain us that The company is using factoring. Is using factoring out of the balance sheet. So the company is selling his accounts receivable for an amount of 2,205 million euros. This is 6% of revenue, okay? So obviously this number for at the end of 19, is it increasing because the company is removing from the balance sheet this amount, 2,205 million. So the company is not improving his working capital for his own operations of working capital. No, the working capital, is it improving because the company is doing a factoring and is selling the accounts receivable out of the balance sheet, right? In the second part, the company is telling us that also the company, ACS, use confirming or reverse factoring, okay? Is using, well, there are another word, it's supply chain financing. And the amount of money for supply chain financing is 1,500 million euros. But in this case, the company has explained us that they maintain the liability in the balance sheet. So they are not selling the payables. This is different than accounts receivable. So this is important, okay? First idea is this improving in working capital is not related for the own operations of the company. Is it related to the selling of accounts receivable? If we advance in the analysis and we go to note 12 in the same annual report, we can see the account for accounts receivable across different lines of the business, right? The total number in the balance sheet is 9,000,500,000, right? Here at the top, well, most of the accounts receivable is related to infrastructures. And here below in the text, the company is explaining us that, okay, this is a factoring, this is factoring out of the balance sheet. This is the amount of money that we talked in the last slide. We told that the company transfer all the risk to the bank, okay, because this is a account receivable securitization that goes out of the balance sheet. And then the company are not reflecting these accounts receivable, okay, in the balance sheet and in the statement of cash flows. It is important here to remember that with the last financial crisis in Spain, the Spain government created the Fondo de Titulización de Activos. This is a SPV fund, okay, to try to eliminate the bad debt from companies and banks, okay. So this number that you can see here, okay, you should to increase this number for 2,550 million plus the account receivable securitizations from the last financial crisis that right now, I don't know the number, but I can try to check this number and I can tell you for the next videos, okay? So this is not the real number. This is a low number, right? Also, when we analyze the factoring, we should to analyze which are the financial costs. And you can see here in the note 28.05 in the same annual report, ACS is paying across 140 million in financial cost. This is related to the factoring, right? So at the end, we have to adjust also the financial cash flow. Here, you can see a reverse factoring in the note 23 at the same report, okay? This is the text in this note that company explain what it's doing. They talk again that this is the supply chain financing. The total amount of money is 1,500 million euros. In 2014, with international accounting rules, all companies should to disclose this table where they should to explain which was the average payable days, right? If you can look here, also is in Spanish, but I think you can understand. So at the end of 18, the average daily sales payable for the company is 23 days. But at the end of 19, the average daily sales payables is 35, okay? So the company is not taking out payables from the balance sheet, but is it increasing, okay? Is it extended the payment terms under reverse factoring with the idea to mask short-term leverage under the illusion that is improving working capital? So in this case, and in my opinion, I think the company the company is not, they don't have a real improving working capital. So what the company is doing is to try to mask some leverage in the short term. So you can see here, okay, this increase in payable days, is it because the company is it extended his payment terms with suppliers with a bank? Here you have a chart where you can see the two difference across the typical way is, okay, in a financial transaction is company A pays for example at 60 days to the supplier, and the supplier sends the raw material to the company. This is the typical draw for a company. For reverse factoring, is it the draw change and the company pays a bank? Normally they pays more than 60 days. So the range here is 60 to 65, okay? I think a bank never accepts more than 365 days, okay? And then the bank pays the supplier and they pays the cash less a discount. This is what wins the bank, and the supplier sends the raw material to the company. No? This is the typical draw for reverse factoring. So also for reverse factoring, if we go to note 24 from 2019 annual report, we can see here in the text and in the table that ACS is paying across 500 million in interest costs related to reverse factoring, okay, especially for international business, but also in Europe and some subsidiaries, okay. So at the end of this analysis, this is the statement of cash flow. So if we go to the here in the line, this number 3, we should to adjust the working capital number, and here we should to add the account receivable securitization, and we should to add sometimes, not here, but could be to add the reverse confirming, and also we should to adjust the financial cash flow in the same way. So, well, this is another way to show of balance sheet liability. So when you try to analyze the debt of a company, taking account of balance sheet liabilities, if you remember, for operating leases in the first video, and today for factoring and reverse factoring. I want to remember you that you can send questions and ask what you want in our email, and you can go to our webpage. And also, please go to our YouTube channel. Here you have all the videos in English, and please, well, you can see all the videos that you want. So this all for today, and have a good day, and I'm going for the next video in the next days.